Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Welcome back to the show, where we interview the nation's leading real estate entrepreneurs. It's your host, Stephen Schmidt, back at it again. And I got Carter Olles in the house today, and we're going to be talking about some high-level stuff. Carter is the co-founder and managing partner of Nautilus, which is a private equity firm, which they acquire existing quality multifamily properties throughout the Midwest. So we're going to go into a conversation today about several different topics in relation to that, his background, and why right now multifamily is a great thing to invest in. So just remember, before we get started, at Investor Fuel, we help real estate providers, real estate entrepreneurs, service providers, and real estate professionals 2 to 5x their businesses so they can build the businesses they've always wanted in order to live the lives they've always dreamed of. With that being said, Carter, welcome to the show today.
Thank you. Thank you for having me. It's good to be on.
Yeah, thanks for being here, Carter. I'm glad we're able to have this conversation. Tell us just a little bit for our listeners' sake so we can kind of get a background, set the tone for the show here. How'd you get started in the space, and what made you decide to found Nautilus and get rocking and rolling with that?
Yeah. To take it way back here. So I grew up in a family who's traditionally worked the W-2. And
Sure.
They built, and both through grandparents and parents, made money in an operating business, W-2 income, pushed it into real estate and built good wealth doing that. And in exploring a career, always knew that was a wealth building solution. That was the way that the family made their money and built their wealth. And I said, hey, why don't we just do this full time? Why don't we focus on that? And so I got into real estate, was fortunate to work with a large real estate private equity firm, acquiring real estate in the Midwest. Most recently ran direct acquisitions for them in the Midwest, bought about $850 million of real estate with them during my time there. So was very active, largely multifamily, but also a little bit of industrial and retail. And about 3 months ago here, left that role on really great terms to co-found Nautilus. We saw kind of a very unique opportunity. We thought from a market timing perspective, also frankly a career timing perspective for both me and my partner. And we were able to put together kind of an initial group to help to get us going out there and do frankly a lot of the same of what I was previously doing, which is acquiring high quality multifamily throughout the Midwest. All existing projects. We feel we can talk a little bit about why we're focused on those existing projects versus new development or doing the development ourselves. But do it in a very similar way, leverage those relationships, connections to do it on behalf of a new equity source. And so we officially launched, like I said, Nautilus about 3 months ago. The market reception has been just fantastic. We've had a lot of demand on all fronts, which is awesome, and focused on buying those high quality multifamily deals throughout the Midwest.
So that's actually really good. It's almost like you popped through the screen and read my first question that that I kind of came up with and wrote down here. But what gap in the market were you aiming to fill with Nautilus?
Yeah, so it's twofold. We felt, from some of our relationships and some of our partners that
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
they weren't served with a quality real estate product and an opportunity to invest in quality institutional real estate. So I think from that perspective, on the equity side, that's really the gap we filled is, bringing, our folks and our the people we're working with an option, bringing them high quality investments, targeting really, nicer, newer, better located assets where we feel the best risk adjusted returns are. So that's the gap we're solving on that side. And then, on the acquisition side and the deal sourcing side, really, focused on being active in our markets, having, leveraging the relationships that we've built over, a number of years here to source and identify, high quality opportunities and match those opportunities up with, proper exits and good valuations for the sellers and see if we can come find some deals. So we offer on a lot of opportunities. We're very active. Our target is to submit about 150 fully underwritten offers a year on multifamily properties and buy the best, 1 to 2, maybe 3 opportunities out of that mix every year. So be very selective in what we're looking at.
What makes the Midwest like a really attractive region for the multifamily investments?
Yeah, a couple things I think make the Midwest particularly attractive, especially right now. We have seen real estate values just generally saw a really significant ramp up, and I guess compression of cap rates that I would say peaked in early 2022. And I think most aggressively you saw that happen in Sunbelt, coastal markets, et cetera. We didn't see quite as much of that compression in cap rates in the Midwest. So I think one, just on a high level, it's a more transactable marketplace right now. I think valuation expectations are more in line. There aren't as many folks that bought, ridiculously low cap rates. There's still plenty of that out there. But I think, from a transaction perspective, we like, the cap rates, frankly, the Midwest is still trading at relative to those Sunbelt and coastal markets. So we like that. We think, just on a current yield basis, that's attractive. But on a fundamental basis, the Midwest tends to, in our opinion, just be more of a steady Eddie type region. It sees a little bit of, less of the boom and bust, the ups and downs, the big peaks in supply. Most recently, in this most recent cycle here, when we look at the coming supply picture, we see a really dramatic drop off in new deliveries in multifamily across the nation, but then specifically in the Midwest as well. And so when we look at the supply demand picture, some of our coastal and Sunbelt markets are actually, peer markets are seeing actually negative rent growth right now. The Midwest at large is not seeing that. It's actually seeing, some of the top rent growth in the country. And that's the benefit that, folks like myself and our partners have always known about the Midwest is it might not be the sexiest market. It might not see the biggest, flashiest, it might not always be the flashy, but it kind of consistently plugs away and does very well. So 2 reasons we like it. I mean, we could talk a little bit about the employment that's coming to the region, right? I think there's been a lot of policy that's driving employment to the region, which is great. There's also, just freshwater access, climate. There's a lot of really nice factors that we think the Midwest, make the Midwest a good spot to invest right now.
Yeah, that's really good. Is there, the Midwest is a really large place. I think most people don't realize that some people, when they talk about the Midwest, they're referring to Ohio, but they could also quite literally be referring to Kansas. And there's a huge land mass difference between those two places. So, like, when you talk about the Midwest, are there any specific portions of the Midwest that you've had really great success in the past that you see are starting to get tapped out in terms of supply? Or
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency. It's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
like, what are some of those challenges that you're seeing on the horizon for that region right now?
Yeah, there's not. I mean, there are certainly select pockets within the Midwest that have seen, they've been more aggressive, they've seen more supply, but at large, part of the reason why we like the Midwest is that there isn't as much of that. There's a lot less of that where you've got a lot. The supply and demand is much more in balance. The target markets we're looking at, when you think of the likes of Kansas City, Columbus, Des Moines. While they might see some, vacancy pops and, some increases in vacancy, generally speaking, occupancies are pretty tight. And there hasn't been kind of that big, glut of supply as we might have seen in other markets. But you're absolutely right that the Midwest is a larger region. There's definitely some markets that are benefiting and seeing more growth that we're certainly more focused on than others. But we're also a firm believer as a firm here that there's opportunities in any market, and you can find pockets of different cities where people are still wanting to move to and grow to. So yeah, that's probably how I would think about it. And yeah, like you said, we're focused on, when we say the Midwest to us is 11 total states, and I think technically Pennsylvania comes in the Midwest on a census side, or at least Pittsburgh does. But we cut Pittsburgh out and we replace it with Lexington and Louisville in Kentucky. We've got some good experience down there and like those markets.
So what's the long term? I mean, I know this is a, not a new industry for you, but a new venture for you. What does the long term look like? What would make this a screaming success for you, do you think?
Yeah, that's a great question, and one, frankly, that's really fun to think about. When we look further out, really we're focused on building an investor first platform that above all else does right and does best by our investors. When we look at it and we look at kind of our family experience and background, my business partner and I are second and third generation real estate, folks respectively. And so we look at, how they've benefited over the years. We look at, our peers in the industry, what they've seen, how they've done well, how they might have not done well. We really see that owning high quality real estate and doing, the absolute, prioritizing, maximizing returns in a risk adjusted and a modest risk profile does best and grows. So that's really our focus, and our core focus is doing those high quality deals, building a company around things like, for example, we look at management, and when we look at the difference between, self-managing or hiring a third-party manager, we look at it and, at the end of the day, almost all the time, the same fee is being charged, whether or not you're self-managing and taking that fee in-house or you're hiring a third-party manager. And when we can go to a market where we, currently have zero assets in the market, we're not looking to fee grab and put the management fee on, take the management fee ourselves, right? We're going to hire the best manager in the market because we think that does best by our investors, and also, ultimately builds a strong track record and builds wealth for them. So it's really about building that platform out into, succeeding for our investors, doing high quality multifamily deals, right? We're pretty focused on staying within, I think, the multifamily space for, the foreseeable future, and really kind of keeping those and in the Midwest as well, really kind of keeping those blinders on, right? And being not a niche provider for our clients, but a very focused provider for our clients, and bring them high quality, investment opportunities in whatever form that may persist.
How do you define a high quality multifamily investment?
Yeah, so I mean, when you look at, I will take that and redirect that question into the
Sure.
negatives, which I think you eliminate, you control for the negatives, and then you by default are then in the high quality. And
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
when we look at reasons why at large investors, projects don't do well, it's really, three, you boil it down to three reasons in our opinion, which is CapEx issues, whether it's just unplanned CapEx issues or vintage related CapEx issues, it's debt related issues, either, via too high of leverage, floating rate term, not enough term, et cetera. And then there's just, business plan failure, which is, hey, we think we can come in here and push rents 30% and our business plan entirely relies upon that. And, assuming you can execute on it too quickly and so when we control for those factors, what that means is that we're buying nicer, newer property. So generally we're technically targeting 80s and newer with washer dryers in unit. We're really focused more on 90s and newer. We're focused on, properties where, the incomes in the area are, can support the median incomes in a, say 3-mile radius can support and cover rents, not just in place today, but also if we're doing any sort of value add or rent improvement, right? We still want to make sure we're within that. We're looking at, like I said, the newer vintage to control for CapEx. We're also, frankly, funding a little bit more than maybe other groups are, in my opinion, into initial CapEx reserves and working capital reserves, because at the end of the day, while that might be a slight drag on IRR, it's in the best interest of our investors and it protects them from any sort of unforeseen CapEx issues that may come up, because the reality is something always comes up if it's small or large, and just having that reserve is of critical importance. We've seen a lot of groups maybe not do that and get burned by that. And then, on the debt piece, right, we're looking at modest leverage. We're looking at, we're a 65% leverage borrower, which I think I would define as modest leverage, moderate. We're, all fixed rate products or, fixed rate equivalents, whether it's through a swap or, in the money caps, et cetera. And then borrowing with, sufficient term as well. Because in the event, things come up, right? Maybe, a new project is delivered, next to you that you might not be aware of. We look at that and we say, hey, term is really, is your friend. And again, you might be able to, sneak out a little bit of a higher return if you had a shorter term, or higher return if you had a shorter term on your debt, and, you could avoid a prepayment penalty, but we would rather have that prepayment penalty out there, kind of swallow that in the event that we want to take a quicker win, because on the downside basis, it just doesn't, we don't feel that really, the extra 50 to 100 basis points you might get on an IRR is worth it for the risk that you're taking.
Right. Let's kind of move towards like an actual question about like acquisitions. What are some of the like most common red flags you look for during like acquisition due diligence?
Yeah, that's a great question. We have a really long and robust checklist of, things we're looking for. And there's not always, I can give a few examples or, of ideas or things that, I may or may not have dealt with in the past, or come across in the past.
Allegedly.
Sure. Not speaking to any specific property, of course, but, at the end of the day, you need to be on a high level to just back up due diligence. And when you're acquiring multifamily property, by the time you negotiate a PSA, maybe you put together some legal documents on an investment perspective, you hire third parties, you're incurring significant cost. And in our world, that's a $50,000 to $100,000 cost. By the time we're, our attorneys, our third parties, et cetera. At the end of the day, due diligence process and period is in there, because if the deal is not what you thought it was going to be, you need to walk. And there's a lot of responsibility on us to make sure we do our diligence before we get to that phase, right? Because we don't want to be, we have a strong reputation to hold up in the marketplace. I've never walked from a deal without, due cause on it. And we have a reputation that we do what we're going to say we're going to do. And so on a high level, right, one, you have to be willing to walk. When we start getting into the specifics of, things we're doing on that, is we're not afraid to spend, frankly, a little bit of extra money or time in hiring an extra inspector. In our world, we have property condition assessments, right? They're done by a third-party engineering firm. They're doing phase ones, but we might hire a builder or a local contractor to come out and take a look at things because it just doesn't feel right. And we want somebody with the real, practical experience. And I'll tell you, we uncovered, I did that once, and we uncovered a pretty substantial, what we felt to be issue that ultimately led us to not pursue an acquisition. And I think that's in the best interest, right? And it was we incurred that cost, we stomached that cost. That was our cost and our cost alone because we walked away from the deal. But it was well worth it, versus deploying 10, 20, $30 million of equity into a deal, which could have potentially had some real significant issues. So we're always very quick to bring the experts out and bring extra experts out that are, tactically, they're day in, day out doing all these things because they can just frankly identify things that, the naked eye might not see or the untrained eye might not see, despite how much training we have. We walk every single unit we acquire with almost no exception, right? If somebody's locks aren't, if the property doesn't have keys to the lock, we'll drill the lock if we have to, within the rights of the lease, right? And that's the property manager doing that. That's not us, but we'll ask for that lock to be drilled because we want to see in that unit. Because that, if you're buying a 200 unit property, it's pretty low chance that's the case. But say if you're on a unit 199, that might be the unit that you identify a real problem, something happening in the building, somebody doing something in the building they're not supposed to be that could cause you real issues down the line. Right. So walking every unit, we audit every lease, right? We're looking at that, to make sure they've got the appropriate income data on file. They actually screen their tenants, right? I've experienced that where the screening process may have been subpar. And now all of a sudden you might have tenants in your property that are actually not qualified to pay the rent.
Sure.
And of course, this is all within, the standard, fair housing laws, things of that nature. And,
right.
This is the property managers make sure we're in compliance there. On a tactical perspective, other problems that we've identified that we've walked from, or at least cause for concern or, ponds are sneaky. Ponds are a real, if you own or are responsible for maintenance on the pond, because sometimes you don't always own them, but there's some sort of like maintenance agreement on that.
Right.
You really, it's really worth doing some real diligence, especially if it's a property that's been around a little while or a pond that's been around a little while. Typically, I see that there's some pretty, there's requirements in terms of how you maintain those ponds that folks aren't always in compliance with. It's pretty easy, I think, for some folks to fall out of compliance with those. And so, right, a sale might trigger somebody to start thinking about, oh, hey, are these guys in compliance? And you as the buyer don't want to be responsible for that. And then also sediment buildup as well. Is the pond, talk about compliance, right? Sometimes you're required to have, or just need to have for the pond to function properly, say an appropriate depth. And there's different ways that they measure it. I've seen some pretty interesting things, but sometimes if you got a lot of trees around the pond, especially the leaves are coming in there, and over a course of 10, 20, 30 years, you might not be in compliance anymore. And that's a pretty expensive, it's not, these are not cheap expenses. So that's maybe a more interesting example. Ponds are scary. They need to be diligenced.
That is definitely one of the more interesting things that I've ever heard actually on this show, that a pond could throw an entire deal off potentially.
And it's not going to throw a deal off, I would say, right?
But
I mean, if you're buying a $70 million property and, it's not going to kill the deal, but you might be looking at a $200,000 plus expenditure that, you get that, maybe something else comes up. All of a sudden, you just spent an extra $500,000 that you didn't think you were going to spend.
Right.
And that obviously is not in the best interest of your investors.
Now, you threw a number out there, like for a $70 million property, I mean, what's that running? 250, 300 units in the Midwest, probably? Or higher?
little bit higher.
I was gonna say that sounds like
I mean,
a big property. How many of those are actually out? I'm in the Midwest. I'm like, man, I can't even think of a property that we've got in my area that's that big.
yeah, it's there's quite a few, man. There's quite a few.
Are there really?
I'm sorry, what was that?
No, go ahead. Sorry,
Oh,
I was just bantering. Yeah, I just
yeah,
said,
no, I
are
mean,
there really? Like, wow.
there's quite a few. I just was talking with a broker yesterday on a $120 million plus property. It's a market that starts to get a little bit large for. You have to be
Hmm.
cognizant of who your buyer is.
Sure.
We think a lot about that, frankly. I mean, and you can have a property, you can know you can have an exit, you can have a strategy on it, you can execute a business plan against this asset, buy it what seems to be a good price, execute a business plan, and on a cap rate basis, perhaps it seems in line. But sometimes, especially on the large side, you can get out of whack on a buyer side, right? I mean, you got to think about too what your next buyer is doing, assuming you want to sell, and even if you don't intend not to sell, you should still be thinking about it and re-underwriting as if you're continually rebuying the asset effectively. Sometimes if you spend too much money in an asset and you raise rents too much on an older asset, you look at your exit basis on a per unit and you say, I don't really know that I love that. I don't know who buys that. Or conversely, if you're in a small, or differently, if you're in a smaller market, and you're buying a property for say 75 million and you're executing a little bit of a value add against that asset and you're growing, you anticipate over a 5-year hold, you're going to grow that value north of 100 million. Who's your buyer on the back end, right? I mean, that's a big check that somebody's got to write. That's a $40+ million check roughly. Probably right around 40 on a $100 million asset if you're, modest leverage, and
Right.
the air is thinner up there in terms of who can write that check. So those are interesting things to think about. But yeah, our sweet spot, I mean, for us, our sweet spot's about, our target acquisition range at Nautilus is $10 to $60 million without a partner. We could, partner with somebody and do larger. But there's plenty of opportunities in that, particularly in that like 30 to 50, 30 to $60 million space. That's really where we see a lot of opportunities for us, at least.
Absolutely. Now, Carter, let me ask you this last question before we kind of wrap things up. What's a question that no one's asked you that you wish somebody had asked you when you've done a podcast or even been in conversation about this space?
That's that I got to think about that. What's something nobody's asked me that I wish somebody would ask me? Um, I spend a lot of time thinking about downside risk, and you've heard that right in our conversation, right? We've barely talked about the positives. We've talked about how all the ways that we try and avoid the downside, right? Because
Right.
that's so much of the battle, and that's so much of
Sure.
what we're focused on. Is we want to execute for our investors, but the first thing we need to do is preserve capital before we can actually grow that capital, right? And
Right.
that's something that folks always don't always think about. So when I think about things that I think should be talked about more, I think that's probably principally it, which is I think I think focusing on limiting that downside and testing and doing sensitivity analyses in your models, also doing the diligence, I think is really important. I really enjoy talking about that because it's a lot of folks, right? You look at an opportunity and you can slice and dice things a lot of different ways. You say, hey, I think this can be a good opportunity, right? But what if not? What does that look like? What if, supply moves against you in the market? What if somebody builds a property right next door to you that you didn't expect, right? Are you gonna still swim on that, or is that gonna put you in a tough spot? So I like to think about downside. One thing I think that's not always, I mean, you probably talk about it a lot. The tax benefits of real estate are fantastic.
Sure.
It depends partially on your tax picture. Of course, I'm not a CPA. I would say, consult with your CPA on your specific tax situation, or but on a high level, many say, and I would agree with them, that real estate's the most tax advantaged asset class out there in terms of an investment. And I don't think folks always think about that and talk about that as much as they do on a after tax basis, comparing real estate to other forms of investment. We think real estate's a really great spot to be. So those are kind of a few little things that I think about a lot, I guess. I don't know that they're probably discussed well enough, but
I mean, I'll be honest with you, man. I relate to that a lot because I had a mentor of mine, long-standing mentor of mine, who's been in my life in sort of an active role, sometimes a passive role. And he recently, I had a conversation with him. I want to say is 8 or 9 months ago, and he looked at me and he goes, "Dude, Steven, you are the most pessimistic optimist I've ever met in my life." And I'm like, or something like that. Like, you're the most negative optimist I've ever met. And it's like, look, man, it's just how my brain thinks is minimize liabilities, raise assets and
Yep.
income. Like,
Yep.
that's just how I operate. It's not something that like I'm sitting here thinking that the worst case scenario is going to happen. But if it does, I'm prepared for it.
And yeah, I mean, to build on that, when you look at any sort of real estate deal you're doing, whether it's your first deal, small deal, right? My first deal, I bought $134, I think, $1,000 home, single family home. That was my first foray into real estate investing. Obviously doing a lot larger transactions since. But at any event, it's a fairly significant form of capital, whether it's, just generally speaking or to yourself personally. And there's risk with the loans you're signing on, right? That's a personal risk. And, or if you're taking investor capital, right? I mean, there's a high degree of responsibility there. And, I personally have been really incredibly fortunate to work with some really fantastic investors, some really, get to be involved and, meet their families, right? Spend time with them, build, friendships with these folks. And whether it's $100,000 check or, it's a $10+ million check, the responsibility that you're taking on, especially when you're taking outside capital, is, in my opinion, something not to be taken lightly. And so, that's what keeps me up at night is, preventing ways that their capital could be, impaired or, it could be put at risk, right? Because that's my job, is to, limit downside risk and maximize upside risk, or upside opportunity, I should say. So.
Well, Carter, thanks for joining us.
Yeah.
Appreciate you coming on here and giving us a half hour of your time for the show. If people want to connect with you for more, where should they go for that?
Yeah, I think LinkedIn's probably the best spot, or our website. So you can just find me on LinkedIn, Carter Olles, Olles. Otherwise, you can find our website. It's Nautilus, NAUTILUS, REI.com. Search Nautilus Real Estate Investments, probably find it that way as well. But would absolutely love to get connected with anybody who's interested in what we're doing or wants to talk more, talk some how to limit risk on a pond. Whatever the case may be, man. But I'll nerd out with you here as long as we I can do it for hours. So it's been a pleasure to be on, and hopefully we'll get back on with you here soon.
Well, there you go, folks. We'll go show them some love from the real estate pros and the Investor Fuel family. Hope you got as much out of this episode as I did, and we'll see you in the next one. Thanks so much.
Thanks all.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.